Hey everyone, how are you today? We want to welcome you to this episode of the HXPodcast. I'm very privileged to be joined today by a relatively new friend of mine, Greg Guenthner of Paradigm Press, where he runs the trade desk. First off, Greg, how are you doing on this summer Tuesday?
Great.
Nice,
no complaints.
And then, remind me, where are you based?
I'm in Baltimore. Just outside of Baltimore. Okay. Yeah.
Okay, got it. Well, I spent a little bit of time in Baltimore through the years across the last half decade. I'm in New Milford, Connecticut, so it's probably it's more or less the same, maybe 5-10 degrees cooler or something like that. So Greg and I met, earlier this year. As many of you know, I formerly worked with Stansberry Research, Empire Financial Research, and there's a fantastic group of companies down in Baltimore that do some great work. And one of the oldest and most well-established is a group called Paradigm Press. And so I had the opportunity to meet a couple of the Paradigm folks, Matt Inslee, and he said, you have a trading product. You should start to talk to Greg. He runs this fantastic trading product we have called the Trade Desk. And so him and I started talking and just kind of swapping ideas and talking about the markets. Greg has a paid product called the Trade Desk. He also has a weekly YouTube that if you look up his name, we'll have him spell it at the end of the podcast. It's got a couple extra letters in there. But maybe let's start. Tell me a little bit about your background, Greg, because I think I know a little bit, but I'd love to kind of just hear more of the full story.
Well, I'm not a traditional Wall Street finance guy. I kind of backed my way into the world of stocks and trading. And it all started, I guess, when I was in college. I went to college to become a journalist. I always thought I'd be a writer. I wanted to write because it was always something I could do kind of effortlessly. And I like telling stories. And I figured that a career in journalism was a way to get paid to do that. And when I started school, it was right at the top of the dot-com bubble. And I was talking to my dad one day, and he said, you're a smart guy. You should try to figure out this market. He's not a market guy. He's kind of always been suspicious of stocks and investments and all that stuff. But he said, hey, everybody's making a ton of money in the stock market. You should invest. And so I cobbled together some money because I think you had to have $1,500 or $2,000 to open up an E-Trade account in the late 90s, right?
Yeah. Back then, and you paid $50 a trade or something. I mean, E-Trade might have been $10 a trade, but yeah, it was a lot more.
Yeah, so I cobbled together some money, and I figured, okay, if I can save $1,500 more dollars, because that was pretty much every penny I had at the time. Yeah, then I'll be able to invest. I'll be able to make all this money. It'll be great. By the time I had saved up enough money, I thought was enough to blow in the stock market. It was already April, May of 2000. And stocks are already going down.
That's what I was going to ask, is your timing was probably perfectly imperfect. So
it was perfectly. I would have lost every penny of my money in the dot-com blow-up if it just hadn't happened to happen when it did. So the whole rest of the time I was at college, the market went straight down, and I just fed into the belief that stocks don't go up anymore. It's not something you do. I just totally forgot about it. So I graduated. I got a job. I worked at a couple different newspapers. Working at newspapers in the early 2000s is also very bad timing because they were getting obliterated by online ads, Craigslist, all that stuff.
Yep.
So, it was not a great career path. I wasn't making a lot of money. I had a girlfriend who wanted to get married. And
can I ask you which one quick question? Because I always find this, and we're going to talk about it because I have a lot of media background also. Which newspapers did you work at? Where did you end up going to Skokie, Illinois, or something like that, or where were you?
So I was in Southern Delaware working for the Dover Post Company when I first got out of college. I was thinking about going to grad school for journalism, but I didn't want to pay for it, and it was probably a good idea that I didn't. And then I got a job working for Landmark Communications at a small newspaper in Carroll County, Maryland, right outside of Baltimore, which is how I ended up in this area. So I figured out I needed to find a new career, something that made more sense, And so I started reading more about the stock market, and I got interested in trying to break into finance. Not easy to break into finance with a journalism degree. No one really wanted to hire me. And I thought I knew something. I had that curse of knowledge where I'd read a little bit, and so I thought I had some things figured out. when in reality I didn't know anything at all. And at the time, there was a small company.
That's called sophomoric. Sophomore actually means false wisdom. Is you've gotten far enough that you know something that you think you know something, but you really don't. That's actually there's a technical term for it. So
yeah, so this is around 2005, and there was a little company in Baltimore called Agora that was hiring folks, and I ended up applying for a couple jobs there, didn't hear much back, and then eventually I ended up interviewing and getting a job at Agora Financial just as a junior analyst, as a writer, just to go in. And this was the one thing that was very good timing. Everything else in my life seemed to be on the wrong wavelength. And then I got into the company and the business at just the right time, where they would take a young guy that didn't know much and let me sort of figure things out along the way. And that's kind of what started my journey. I started thinking of myself as like a fundamental investor back then. I was reading all about, fundamental investing techniques and all that good stuff, value investing. And then when the financial crisis hit, I realized that I needed to figure out how the markets really work. And that's what turned me toward technicals. And throughout the early part of my career, everybody I talked to told me that technical analysis was voodoo, that it was a self-fulfilling prophecy, that it was a shortcut, and that it wasn't real analysis. And this is before technical analysis really took off. I feel like social media has given technical analysis a launch pad, and it really wasn't a very mainstream thing.
It's opened up a lot more. We'll talk about that subject in a second, because I have some good stories from you from way back when. But
yeah, so I mean, no one really legitimized it, at least not the people that I was surrounded with. But it made a lot of sense to me when I first started reading about it and figuring it out. And just learning about how the markets work and market sentiment and just animal spirits and all that stuff, like, started to make a lot of sense to me. And it started showing me the things I was doing wrong when I was thinking about longer term investing too. And from there, I went on and I got my CMT. And technicals have been the bedrock of everything that I've done since then. And so I have longer term.
Just so our audience knows, and because I think some of them don't, CMT is a chartered market technician, and it's a course. Does it take a year, or it's got a certain? It's a fairly large course, but you have to take the course. You have to take an exam. Just so the audience is unaware, you'll see things. A CFA, which is a chartered financial analyst. CMT is basically the technical analysis version of that. So.
Yeah, same idea. It's 3 tests. It takes about 18 months to complete everything.
Yeah, there you go.
Yeah. But it's the technical side of that. The joke is that we say in the industry, the CFA is going to get you the job and the CMT is going to let you keep that job. So actually make you the money. So, yeah. But yeah, so I mean, everything I've done since then has been rooted in technical analysis. And I do mix in fundamental and trends and stories and all that with the things that I do. But for the most part, like, I like to have price dictate my actions in the market, and that's worked out really well for me, both on the long term and the short term side.
Yeah. Well, it's interesting. You and I share like a tremendous amount of commonality. Our end place is the same, and some of our beginnings are the same, but very different. I always was interested in writing. Originally, I wanted to be a writer, and I was like, I only applied to a few schools like Harvard, Georgetown, Penn, Wharton, and I basically decided to not be a writer because I was fucking poor, and I didn't want to be poor, so I went to Wharton instead of being a writer. But then at Penn, I was the editor-in-chief of the second largest newspaper. We had a circulation of like 5,000 or 6,000. We published monthly. I was a managing editor at the Wharton Journal. And then, 8 years ago, when I first stepped away from Wall Street, I actually went out and formed a media company. And as you know, I bought up, Revolver magazine, Inked magazine, etc. So it's this funny thing is you were a journalist that kind of went into finance. I was a finance guy that was like kind of always steeped in journalism or writing. I will say writing because I think what you and I do is writing, not journalism at this point. There's a lot of similarities there. So what do you look, you and I have spent some time together. Let's delve into a couple issues. So I still think there is a perception out there that technical analysis is kind of bullshit. It's just voodoo. It doesn't really it's just, it's like reading tea leaves. It doesn't give any value. I know that's not true. I have many reasons why I've shown it's not true and believe it's not true. But how do you, when you get that question, they go, oh, you're a technical analyst. What the hell is that? How do you take that question when you inevitably get hit with it, at a cocktail party or something?
Well, I approach it a couple different ways. First of all, I think going back to what we were saying about social media, I think it was the best and worst thing that ever happened to technical analysis because it gave a huge platform to people. And you have all these charts that are floating around online, and everybody can share their thoughts and opinions about things. Anybody can draw a line anywhere on that chart and share it. So you have a lot of folks that are sharing all this information, and a lot of armchair technicians out there who maybe don't really understand it, who are sharing things like, this is definitely making these big predictions. This is definitely going to happen because this stock crossed this line. When in fact, we all know that that's not really how things work. So, and I think also what comes along with that is the fact that technicians get a bad rap because people see a technical pattern fail and they'll say, hey, there you go. It doesn't work. I can prove it right here. If you look at this chart, it doesn't fail. But then if a fundamental analyst says something that doesn't happen with a stock, it's not, hey, fundamental analysis doesn't work. It's, hey, this analyst is an idiot. So
can
really
I make an analogy, though? Because you just brought up something I've never thought about. Like, I always think that, look, everyone is always, I don't know if it's genetic or our society or whatever, but almost everyone is always attracted to fundamental investing first and attracted to value investing. And I have some reasons why I think that psychologically is very true. But, you talked about, I use the term sophomoric. In many ways, what you're saying about technical analysis to me is true about value investing, which is, anyone can find a cheap stock. Anyone can tell you what the price to book is. But to actually turn that into a money-making enterprise, it's actually almost the opposite. The cheap stocks are generally the worst stocks unless you really know what you're doing. And I feel like chart patterns, the easy to identify patterns, are sometimes the worst patterns unless you really know what you're doing. But it seems to draw people in initially, and it's very dangerous. Like, amateur technician, being an amateur technical analyst or an amateur value investor are probably the two most dangerous things you can do in the stock market.
Right. And honestly, I'd almost rather be an amateur technician because an amateur fundamental investor, somehow they believe that they're going to get some sort of unique information that's only available to them, or they're going to be able to capitalize on the information out there that's on Yahoo Finance or on some obscure article they find online. You're never going to beat the basement full of computer scientists somewhere in New Jersey that Goldman Sachs has employed. That's my whole argument against that type of investing for timing the market. I'm sure you're going to find some interesting stories. But when it comes down to it, where the rubber hits the road, you're never going to have more information than the people you're trying to beat in the market. And I think that's kind of what sets technicals apart. It's saying I don't need that information because I'm going with a trend.
And that information is all there to a certain extent, meaning that the information, to me, price is the ultimate arbiter. And there's one piece of information that is final. It is price. We can argue what's the right metric. We can argue about what's the right way to look at this and this, that, or the other. We can even go through the metrics and go and disagree on the calculation of a metric. We can't disagree on price. It's right there for you to see. So
if I had a time machine and I could go back to when I first was really starting to learn about the markets, so that's the one thing I want to tell myself is that what you hit on earlier, a cheap stock is cheap for a reason. It's because nobody wants it, and an expensive stock is probably expensive for a reason, mostly. And that's a tough concept to reconcile until you kind of have that aha moment. And I think every investor, if you don't get booted from this market, and you can stay learning and invested, I think every investor will get to an aha moment like that. It might be different for them, but I think investing is a personality-based thing, and some people are going to be good or better at investing with technical. Some people are going to be better at investing with more fundamental information. But I think it has to go along with how you feel and how you process information and how you react to things too.
You said I love what you said there because like I know when I started I wanted the most. Now I also started a little bit before you and I started in the depths of finance. So, I was at Lehman in the early 90s and I worked at hedge funds in 96, 97. And by the way, we were able to get legally information that wasn't out there, like, through doing the research and stuff. But that really, as we moved through the internet's expansion into the early 2000s, just really began to die away. But there's this thing is that it's much sexier or it sounds a lot smarter to do something complicated than it is to do something simple. But in the markets, like, when I first, so when Whitney Tilson, who I think you've met Whitney, but Whitney decided to go to Empire or create Empire. He told me, he's like, oh, I'm going to go work with this guy, Porter Stansberry, who I didn't know at the time. He's absolutely brilliant. But, he's like, I'm going to write an investment newsletter. And I'm like penny stocks? Like, what the hell are you talking about? Like, and they goes, no. They do this really good job of taking complex subjects and simplifying that. That doesn't make them dumbing them down. It means just getting rid of the fucking noise. And I feel like Wall Street, they get paid for the noise. Like the whole point is the noise. I was talking to a friend of mine today who runs this biotech firm. And he told me, he said something incredible to me. He goes, I think 90% of the updates that I do to my models and everything, I don't have a single reader that reads. And I was like, what the hell are you doing? Like, why even bother to do it? But simplicity is actually as important in investing as is your process, in my opinion. So,
well, right. I mean, people are storytellers. We want the story, and I think that's another point against technical analysis is that there's a lot of technicians out there who I think are creating and sharing charts and indicators and that sort of thing. They're sharing them for other technicians. And they're not sharing them for investors because they constantly want to pull the story out and say what we were just talking about. They want to say like price is king. This is what matters. Look at this here. I think you can, coming from the newsletter world, I think it's important to weave in the story and the sentiment and everything that goes around in that because that's what people are going to respond to. And this from writing. It's you tend to get feedback from personal stories, from market anecdotes, much more so than winning trade ideas and anything else. People are going to be attracted to personality and stories and something they can tell their friends. They don't want to tell their friends, number go up, me buy. Isn't that interesting? They want to say like, hey, this company is creating an AI interface that's going to be the next big thing. And so I think all of that's super important when trying to convey these ideas, especially to Main Street investors, because that's the exciting stuff. That's why we're here.
You do a great job. I've seen, I do it kind of naturally and in my own way. You do it more overtly, and I really appreciate it. You focus, when we talk about rotations in the market, you focus on the narrative rotation because there is a narrative rotation. But one of the big things that I have, and this is for both investing and trading, is I have a big thing. I said we're buying stocks, not companies. And, I always tell this story that Amazon, so if a stock is supposedly worth the present value of the net cash flows of the enterprise through time, Amazon has paid no dividends and bought no stock back and has gone from 200 million market cap to 2 trillion market cap. And I haven't seen a fucking dime. So apparently, that connection is tenuous. To me, stocks are products. It's literally a product. And so understanding products that people want to buy, and again, because I'm not a debt holder. I'm not financing the company. I'm buying this product at 10, hoping I can sell it at 20. Okay, that's literally what I'm doing. So that narrative, and I like what you do a lot because you're combining. We do something called quantum mental, which I didn't make up, but you've heard before, where we have probably in our trading stuff, we have a half a dozen quantitative things that we always go to. Is the company profitable? Is the company growing? Are they beating expectations? Are earnings estimates going up? Is the chart up and to the right? Like those are kind of like my 6 things. You actually do another and you capture a lot of that. You actually do a very good version of kind of going through the story and trying to understand what narratives are out there. And I've started to weave it into some of the stuff that we do.
Yeah, I think that's all super important. And I think it's a much more personable way to discuss what's happening in the technical world rather than throwing 1,000
Right.
charts at somebody. Because I mean, I love these. I love to get wonky with charts and sit down and go to a CMT function where there's somebody that throws 300 charts up on the screen rapid fire and they're just talking about each and every one of them. But you're not going to remember all that at the end. You're going to remember the joke they told at the beginning or something like that.
I'd love to go to the one where they just throw up 3 charts that are going to make me fucking money. That's all.
That's great too. Yeah, but you know what people get? They're just like, I'm going to kill you with all these charts. There's so much going on in the market. Let me show you. And yeah.
So some of my best friends are chartists that I've known for years. And many of them have this process, which I used to do a version of, where they go through 300, 400, 500 charts and hand chart them. And I get it. Yeah. I used to do that. But now I actually go through like one technical signal, because we do a lot of buy dip in an uptrend. We go RSI below 30 and back above it with a stock where the 50 and 100 day are above the 200 day. So I just did 2 things right there. That's all I need. And then I just focus on those 15 stocks. And I'm like, screw everything else. Like, I don't need to, because there's going to be gold in those particular hills. But yeah, the chartists tend to get too involved. So I've seen you, we were talking a little bit about before, I've seen you, and we're in a bull market. So, obviously an established uptrend with a potential breakout is a strategy. But if you were to sort of say, if you were to break down your preferred strategies into, look, your preferred strategy is make money. Do anything. My preferred strategy is do anything that's legal to make money, in the markets. But what would you say kind of where you feel most comfortable, 1, 2, 3 strategies, what you sort of focus on the most?
Well, the 2 things I focus on really, because I have 2 different thoughts about this. I have longer term ideas, and then I have my shorter term swing trading ideas. But they all are birthed from the same principle, is that I want to find stocks, like you said, moving from the bottom left to the top right of the screen. And I can find different ways to trade both those ideas. For longer term ideas, my whole philosophy is I want to find position trades that can turn into much longer term trades. So I like to marry like a really good elevator pitch fundamental story in a very strong stock with a technical breakout, a technical breakout of some kind. And so I guess like a good example of that would be like the Meta IPO, which was Facebook then, back in 2012. So Facebook IPOs in 2012 and immediately craps the bed.
It gets its ass kicked. Yeah.
It does nothing for a full year. Well, the whole narrative around Facebook in 2013 was they're not going to be able to monetize mobile. Facebook was primarily a desktop tool. Everybody and their uncle was getting on it. This was back around the time where it wasn't just young people. It was like everybody. Your grandparents were getting on Facebook, and it was becoming a big deal. But analysts were worried that they weren't going to be able to move people's eyeballs from their desktops to their phones, which are still a relatively new idea, having an app on your phone to do those things in 2012, 2013.
The iPhone came out 2009. Am I getting that right? 2011. I
didn't have one until 2009 or 2010. I don't think. I'm not an early adopter. Maybe 2007.
I'm going to Google it. It's going to blow you the fuck away. First come out.
2007.
Okay, 2007. You got it.
Boom.
Yeah.
So all of 2013, it was all this talk about how they can't monetize or they can't get eyeballs onto the phone. And then they had that one earnings report in summer of 2013 or whatever it was, where the stock shot up like 30 or 40% in a week,
I see it on the chart,
and that was it, and it never looked back. And the best part about an idea like that is that like you have a very easy pitch, as in social media is going to be huge. It's the future of how we're going to be using the internet. You have a stock that has just defied the narratives, and a young CEO that's proven that he can actually operate in this new environment and probably knows more than these analysts about how the business is going to go. You have a massive breakout where you don't have to be early. You don't have to guess. You can be much later. It had gone up 100% 6 months later. So you could still be buying at any time along there and be right. And then you have a potential position trade where let's hold it for 6 months, see what happens. It's doubled. And then you have a big enough cushion to basically, deal with any type of turbulence in the market, and you can hold on to that for as long as you can.
Well,
obviously, that's an ideal idea and an ideal trade situation, but that's the kind of things that I
for the
look
long
for,
term.
For the long term.
You touch on, I have a buddy of mine that I mentored, a guy named Ram, and I can't pronounce his last name because it's very, very long. And he worked with Brad Gerstner at Altimeter out in Silicon Valley. He was our technology guy, and he joined us. The first buy side job he had, he sat right next to me. And you should actually watch the podcast. I'm not trying to get you to watch the podcast, but his Octahedron Capital, honestly, it was amazing. He has turned into an incredible money manager. But he has this concept. Is I always talk about TAM. So when we look, it's the same thing. My belief in a long-term investment, if you don't think it can double or go up fivefold, why are you even getting involved? Like if you're trying to like look, and there's things that can compound that can double and things like that. But I'm sort of like, if I can't make 3 to 5 times my money, I just know life is too short. But he has this idea. It's not just TAM, but he's looking at. He calls it like the platform. Do they have a platform that then, and Meta was the perfect platform stock. He talked on our call. I don't know, have you ever taken a look at Nubank, which is the Latin American? It's basically a Latin American online bank that they thought they were going to have 10 million customers, and now they have 150 million. But again, it's this like platform business. So I love that approach, like looking longer term. So you're looking for, I'm gonna rephrase what you said a little bit. Yeah. Looking for large TAM / platform businesses with a strong narrative. I like what you said about the young CEO, and then waiting for a confirmatory breakout to, put that. I'm going to add one last thing that I would put in there is, and they almost always go hand in hand. We wait for confirmatory operational results because that breakout happened not because people woke up and said, oh, the stock should go up. That breakout happened because they blew the number the fuck away. And people were like, oh my God, this company's going to start earning. So it's kind of like I look for those hand in hand because if those start to decouple stock and earnings momentum, I'm just kind of like, life is too short. Okay, so that's your long-term methodology or parts of it. What in the shorter term stuff, how do you look at the world?
Well, I want stocks like that. So that are moving, okay. but I'm also looking for names that I know have strong momentum capabilities. So I spend a lot of time looking at charts. Obviously, I really don't think there are too many shortcuts to that. I think that if you're going to be a shorter term trader, you have to commit yourself to constantly watching the market and constantly looking at charts. Spend time on the weekend looking at the entire S&P 500, things like that, because you can scan and you could whittle down your universe like intra-week when you're looking for things. But I think it's also important to just go through everything and see what's happening in the markets. And then you'll start to find stocks that you can familiarize yourself with. Like you said, it's like if I'm going to be trading, I want to be trading because I know this is where the money is in this group of stocks.
Yeah.
When you find a stock that tends to break out and run, that tends to be a good momentum mover, then that's a stock that you want to keep in your back pocket and always, be going back to because that thing can really go. Because if you're, if you're swing trading, you're going to need it to actually break out and stick and hold and have these momentum moves, or else you're just going to be treading water half the time. So the worst thing you can do is just try to trade any old breakout and just hope for the best. Yeah. You really gotta know like what's going to move and what's not.
I haven't followed your stuff as much, but I think this is going to be true from what I have followed. I mean, I'm actually recommending something tomorrow in our trader product that we've recommended 3 other times before. I
do that a lot.
I saw you do it with one stock here recently where you actually went long to short via calls and puts. But yeah, I feel like you kind of can get more of a view if they're just companies that and are good raw material, that you stick with those, as opposed to I think where a lot of retail and amateur investors get just fucking destroyed is going to the next stock that no one's ever heard of. And there's a way to trade those, in my opinion, but it can be very dangerous because they're binary with a giant 0 and a little 1. In my opinion, it's kind of different type of binary.
Well, yeah, I think that happens too because we always want the next big thing. It's like, okay, I've
Yeah.
made money on X, Y, Z. What's going to be the next whatever? And the financial media does that all the time. They're like, this could be the next Nvidia. This could be the next Apple. This could be the next whatever. And you know how it goes. But yeah, I run through a ton of charts. I do run scans to try to narrow down, lists of potential trades. But there really aren't a lot of good shortcuts. So, I'll get those flag breakouts or those pennant breakouts. I never want to be guessing. I always want to know that something's moving.
Explain the simple version of a flag and pennant breakout, just for so that everyone understands that.
Let's say you have a stock that's gone up 20% and starts to consolidate. It gets tight, and then it breaks out to the upside. You can probably expect an equal move, or so. You're like half maxed. So you can expect an equal move once it breaks out of that pattern. It doesn't always work, obviously. Like nothing always works in the market, but that's usually a pretty good indication that there's still strong demand for that stock. The tighter that it consolidates, the better it behaves, the more likely it's probably going to break out and hold that particular breakout. But I also like other type of market events that kind of prove the consensus wrong and lets you know that you're kind of on the right track. I love to trade stocks that gap down on quote unquote bad earnings and then finish the next day positive and buyers coming. I mean, that's one of the best signals you can get in the market is when you have some sort of big morning sell-off on whatever's perceived as bad news, and then it turns into, oh, maybe that's not so bad, maybe it's actually good news. You can get a lot of meat out of a trade like that because it's gonna fool people. It's like a false breakout or a false breakdown. It's that type of thing.
That is our strategy. Is literally our core strategy is finding an uptrending stock. We wait for it to get very oversold, RSI below 30, and trade back above it. But then we go back and look at the long history, the 2, 3, 4 years. We don't necessarily have to see that reversal the next day. But by the time you goes back above the 30 RSI, we're waiting for the reversal, whether it happens in a day or whether it happens in a week. Because in your scenario, what would happen is if it actually does it the next day, you go back through that 30 immediately, right? And so you might, but I agree with you. The best ones are generally when you go back through 30, go to 17 one day and 32 the next. You buy that stock almost every single time. I don't even need to know anymore. It's a hard pattern to find, like to get that degree of trauma and recovery that quick. Like
it's always good because you're guaranteed that there's a lot of people on the wrong side of that trade, and that always helps out.
Right. Yeah. No. I think it's a great point. But
yeah, there's other potential plays like that too. Like institutions tend to pick up stocks when they drop below 200-day moving average. That's kind of similar to what you do, maybe a little bit different, but it's the same kind of idea. It's that like you're getting into these buy points for these longer term minded investors in the time when professional money managers are going to be scooping up a play like that. And if you get some confirmation that it starts turning around and moving up again, you have your great risk reward entry for a longer term play.
Yeah, no, without a doubt. So what do you like? Let's go back to, I call it the Thanksgiving question. Your cousin comes up to you Thanksgiving, and cousin you don't know very well, and he says, "Hey, I'm interested in the markets. I'm interested in stocks. You've been doing it now for 20 years. Really going back to the .com crash. What should I know?" Now, all the professional money managers always start with, okay, you should just get a professional money manager. That's kind of the first. Newsletter people don't, okay, I think. But I always say, well, they're the person's stock interested. It's like they want to buy a motorcycle, okay? Whether they should own a motorcycle or not, I actually think motorcycles are fine recreational. I grew up on motorcycles. But you're going to buy a damn motorcycle, so I'm going to tell you a couple things about being on a motorcycle. What would be, 2 to 5 things that you would really emphasize as core, like, I call it the sticky note rule. Like, take a sticky note and stick it to your screen. What would you put on the person's sticky note on the screen?
I think 3 main things. The first would be to understand that markets trend and learn what that means. Learn that markets aren't random and that there are uptrends, downtrends, and sideways trends in the market, and learn how to spot a longer term trend on a chart.
Okay.
That's the only technical analysis you need if you're going to be, a longer term investor.
William O'Neill. There you go.
Yeah. So learn that concept, because I think a lot of retail investors don't understand that concept.
Okay.
Once you learn that, understand that, and this goes back to what we were talking about earlier, that you are never going to have more information or better information than the big professional investors. And there are no
Okay.
secrets
Yep.
that you can find out there. No one has a
Yeah. Yeah.
secret that they can give you that's going to make you be able to get in on a stock that's going to go up.
Not a
They're
legal
not
one.
gonna,
They don't.
right, exactly. And then the next one I would say is like invest in what you know, kind of the Peter Lynchian idea. Like find something you can be passionate about. If you're a computer guy, then maybe you want to invest in tech stuff. If you're a mining engineer, then maybe you should get interested and learn that industry. But make sure that, and I think the saying goes, have strong opinions, but have them loosely held.
Yeah.
Learn how to go all in on an idea, and then be able to cut and run if it doesn't work out. Because I think that's another thing that folks have a lot of trouble doing. Professionals have a hard time doing it. We see it all the time.
Yeah. No, I think that's great. You know, what's funny is that, like, I only started doing these interviews, you know, as part of this. I had a podcast previously. We had a crazy podcast where we took this is during the height of the little baby bull. We took $10,000 with this guy who worked with me, who was like a punk rocker. And we traded it in crypto and NFTs. We turned it into about, at one point, it was $140,000. Well, I'm talking about, we did this in months. But we literally, the point was, it was the FOMO, not the FOMO, the YOLO portfolio, right? Like we would go out. Yeah. So it was very professional, yet completely unprofessional, because we would literally get on the podcast, and the first thing we would say, do not do anything we're about to talk about right now. But I will tell you, in exploring the extremes, it ended up being both an incredibly interesting podcast and incredibly educational, because we went to like these far extremes. But I was going to say, we're on maybe the 20th episode of the HX podcast. I forget where we are. Every single person I talked to, who are all very successful, know what you're investing in. The first book on my Twitter profile is Peter Lynch's One Up on Wall Street. I also kind of put with that, I say similar but different. I say do the work, you know, because there's things you can like not know, but you can learn through time. Like you meet guys like you and I, like you didn't know shit all about copper 15 years ago. Like you're like copper, like Duracell batteries kind of thing. Maybe you did. Maybe you know a lot about copper, but
I didn't know
but now you follow copper for a decade, you know that, but do the work. I think it's so powerful. But that last one that you kind of threw in there, I always tell people I have very strongly held opinions, and I pride myself on changing them quickly. You know, that's the most powerful, because you need conviction, but you need to have conviction plus flexibility maybe. And I think in trading, that's like the most important. That's the most important thing. So, okay. So understand trends, which I think is key. Do the work. Number two, understand that you will never know more than the market, you know, that the other people will know, and respect that. And then number three is trade what you know, or what you can know, or what's interesting, as well as maybe you put a number. You this was maybe 3A, but I think it gets its own number 4. Have strong opinions and be willing to change your mind, you know, quickly.
Yeah.
I think is probably you know, a very, very powerful one in there. One last couple questions. What's the craziest trade you've seen in the last 18 months? What was the craziest
trade?
one? The craziest one that you saw. I'll tell you what.
That I put on, or the one that I saw.
Yeah. No, the craziest one that you put on. What was it? Not meaning that it was a crazy idea, but it worked out in a way that you were like, whoa, how the hell did that happen? Like,
I'm trying to think of some crazy trades that I've done recently. I played last summer. There was a huge okay. Let me start this again. So last summer, the market really wasn't doing much. It was like around August, I think, and there was a few breakouts that were really standing out. One of them happened to be Rivian. I know we've talked about EVs recently, but I ended up buying Rivian calls, and the thing just went straight up. I wasn't expecting. I was looking for like a double maybe on the calls, like just short term, and it just absolutely blasted higher. I don't have the chart in front of me, obviously.
Well, can I tell you something crazy? So that was in July, or June or July.
Oh, it was July? Okay, yeah.
Yeah, no. But I'm going to tell you something crazy about that because, and Rivian went, hold on one second. Rivian literally went on June 26th from 13 to 26 in like a day or two. My craziest trade of the last year was actually Sirius XM. And we had got into Siri because they were buying back a bunch of stock, but then the numbers finally turned on Siri. And literally 2 weeks later, there was this crazy, because there's this arbitrage between Liberty, Siri XM, and Siri went from $4 to like $7.25 in like 10 days or something like that. And I was just like, get the hell out, like get out of the whole damn thing. So it's funny that they happened at the same time. Like, because I think that probably tells you something about the what was going on with the market at that time. Okay, so one last thing. Do you have kids, by the way?
I have 3 kids. Yes.
Okay, yeah, me too. I got a 10, 11, 7, and 3. If you had to give them one piece of advice about the market, what would it be? And it could be something very simple, like
That's a tough one.
You want to know what mine is? You know what? Well, no. If you had to give them one piece of advice, you can never talk to them about the stock market again. And my piece of advice, and there's a couple of ways to say this, okay? But time wins. Okay, you could also call that the power of compounding, right? First off, they got a hell of a lot more time than we do. But if I had to give one thing to them, I always joke. I think Warren Buffett's a brilliant man. I think he's a great investor. But one of his investment strengths is that he's 147 years old. It's like if I get 100 more years, I'm going to do pretty well. Once I got to. So anything you would think of to tell your kids beyond that, and I'll let you off the hook if you can't.
That's a really good one. I don't think I could do one that good because that's perfect. But I guess if I had to tell them one thing, it would be that you can't bend the market to your will.
Okay.
Like you can't force your logic upon the stock market and expect it to obey it. The market doesn't care what you think. How about that?
I think that's a powerful move. I always call that one too, hit the ball where it's pitched, right? That's a very baseball version of it. But I'm like, you can't you gotta surf the waves you've got, not the waves that you want. Okay, cool. So if people want to find you, they obviously can go to Paradigm Press. You have your YouTube show is every Tuesday at 11 a.m. Eastern. And it's called the Trade Desk, yeah?
The trading desk is the trading product, and we do Top Trades Live every Tuesday at 11 a.m. Eastern. Live. Yeah, me and Matt Inslee. We rip through charts and we talk about what's moving in the markets that week and what I'm looking at, and where all the good trades are going to be coming from.
Okay, cool. Well, I encourage everyone. Like, I love the work that Greg does. I'll tell you this, Greg, is like, I ran hedge funds, billions of dollars for years and years. I actually have learned so much in the last few years from actually working with people like yourself. Like, I kind of call it the Baltimore crew, but it helped me simplify and boil down my process. So I really enjoy our engagement, day to day, because I'm like, there's just constant little things that you're like, I'm adding to my toolbox or that keep me focused or generate ideas. So, I appreciate the opportunity that we have to talk so often. So, okay, good. Cool. Great. Well, I want to thank everyone for joining us on the HX podcast today. Again, Greg Guenthner. Can you spell your last name for us? Because I want to make sure I get that right.
Guenther. Exactly how it sounds.
It's that extra NER in there though. Yep. That got me the first 20 times. I'm like, I couldn't get it. Check him out at Top Trades Live on Yoohoo, the Trade Desk at Paradigm Press, and we appreciate you joining us here on the HX podcast.
Yeah, thanks for having me.